Welcome to the best investment writing, your gateway to the minds of the world's most respected investors. Join us as they unveil the insights gleaned from their tireless research, providing you with invaluable perspectives to enhance your own investment journey.
All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
My name is David Vick, Managing Director and Head of Fixed Income Portfolio Specialists at TCW. TCW is a Los Angeles-based asset manager founded in 1971 with just over $200 billion under management. The lion's share of those assets are in fixed income, with strategies spanning the full spectrum of market sectors, risk profiles, and liquidity, in vehicles from mutual funds to ETFs and SMAs. While my focus is on the fixed income side, we also offer a broad array of strong equity and alternative strategies as well. Please visit our website at tcw.com to learn more about how we can help you reach your financial goals. Now let's get into the episode. I'm going to read a piece published earlier this year called When the Market Outgrows the Index. There are three key takeaways from this piece. 1. Recent fixed income volatility highlights the limitations of the Bloomberg U.S. Aggregate Bond Index, commonly referred to as the AGG, a key index for fixed income investors. 2. Nearly half the opportunities available in fixed income aren't represented in the AGG. And 3, actively managed ETFs are a potent way to diversify a fixed income portfolio. So with that, let's get started. It's been nearly 40 years since the AGG became the industry's fixed income standard benchmark for the broad, high-quality bond market in the United States. But in today's market, does it really reflect all the opportunities that are available to investors? With nearly 14,000 individual issues worth more than $29 trillion in market value, the AGG includes a wide range of securities across multiple sectors, including Treasury and other government-related bonds, corporate bonds, and securitized issues. As with all indexes, however, there are rules that guide the construction of the index, limiting the number and types of securities that are included. Traditional fixed income portfolios are tethered to the AGG and typically primarily hold securities that also are included in the index. But those traditional strategies miss out on opportunities available in the roughly 47% of the U.S. fixed income markets that aren't included in the AGG. This is a significant constraint amid the volatility that is taking hold as markets wrestle with stubborn inflation, tariffs imposed by the Trump administration on trading partners, and global polarization. Unlike in previous cycles, though, today's investors have more choices to position their fixed income portfolios outside of the AGG, including active ETFs. The big issue is that the AGG only includes bonds that are rated investment grade, publicly registered, have a fixed-rate coupon, at least a year of maturity remaining, are denominated in U.S. dollars, and meet certain minimum size requirements. These rules exclude large segments of the market, including floating rate issues, which is the vast majority of the asset-backed securities markets, including collateralized loan obligations or CLOs. It excludes inflation-protected securities or TIPS, unrated and below investment grade issues like high yield and bank loans, and also short-term instruments like money market securities. And finally, it excludes bonds issued in any currency other than U.S. dollars. In total, these excluded sectors in the U.S. alone account for an estimated $26 trillion and more than $110 trillion globally. Clearly, there's a whole universe of bonds not included in the AGG. In the paper, there's a graphic here with a smaller circle inside a larger one, the smaller circle including just those sectors covered by the AGG, and the larger one including a wide array of securities and sectors not included in the AGG in any meaningful way. So not only are there a host of sectors not included in the AGG, but the ones that are included have changed over time due to long-term issuance patterns. In particular, U.S. Treasury bonds make up almost 45% of the index, while other government-related sectors add another 4%. Corporate bonds comprise 24%, while securitized issues, mortgage and asset-backed securities, make up the remaining 27%. Given high current deficits, Treasury issuance has been robust, causing the percentage of treasuries in the AGG to steadily move higher, and we expect that to continue as the U.S. budget deficit grows. Again, there's a chart in the paper that looks at the historical sector weights of the ag from its inception in 1976 to current, and you can see a pretty clear trend of a consistently rising Treasury allocation over the last 15 years or so as Treasury issuance has been robust. Additionally, the potential upside from the ag is limited because nearly half the ag is comprised of these Treasuries. In essence, that means investors may be leaving money on the table. Historically, many of these non-index sectors have been outside the reach of the average investor, requiring special expertise, sophisticated analytics to understand and price the different types of risks that are present in these securities. Today, however, actively managed ETFs provide an effective and efficient means by which any investor can benefit from the expertise of professional managers tapping into the abundant opportunities potentially available in sectors outside of the ag. These ETFs can be targeted in nature, focusing on a particular sector that offers a specific risk-reward profile that may be attractive for certain investors. For example, a dedicated CLO ETF could be a solid, high-quality income solution for some investors, while one that focuses on senior bank loans would be a better option for an investor with a higher risk tolerance who also wants a higher level of income. Investors can also tap into a broader, active ETF that is designed to navigate across the entire fixed income landscape, identifying opportunities across sectors and individual issues. Without any tether to the ag and with the ability to invest more broadly across the universe, those ETFs can provide flexibility and the potential for attractive returns across a wide range of market environments. This isn't the first time that a market outgrew an index. The NASDAQ Composite, for example, became more influential when the traditional companies contained in the Dow Jones Industrial Average didn't reflect the growing investor focus on technology. Now, the ag could ultimately modify selection criteria to meet the market's expansion, but there's no telling if or when that will happen. And in the meantime, investors want more choices, more flexibility, both of which are especially important when markets are in flux, volatile headlines are driving significant uncertainty, and sentiment is shifting seemingly daily. There's just no time to wait. This material is for general information purposes only and does not constitute an offer to sell or a solicitation of an offer to buy any security. TCW, its officers, directors, employees, or clients may have positions in securities or investments mentioned in this publication, which positions may change at any time without notice. While the information and statistical data contained herein are based on sources believed to be reliable, we do not represent that it is accurate and should not be relied on as such or be the basis for investment decision. The information contained herein may include preliminary information and/or forward-looking statements. Due to numerous factors, actual events may differ substantially from those presented. TCW assumes no duty to update any forward-looking statements or opinions in this document. Any opinions expressed herein are current only as of the time made and are subject to change without notice. Past performance is no guarantee of future results. Copyright 2025 TCW.
If you enjoy the show, be sure to leave us a rating and a review on your favorite platform. You can read investment research like you heard today by subscribing to The Idea Farm's free weekly e-newsletter at theideafarm.com. Thanks for listening, friends, and good investing.